Hi, everybody, and welcome to the Wall Street Report. I'm Jennifer Schoenberger. As the new year opens, stocks have had a strong start. Standard & Poor's 500 stock index is sitting at a 5-year high. But investors are staring at many of the same issues from 2012. For starters, we're only at intermission in the fiscal cliff drama. Congress made a deal on taxes, but deferred a compromise on spending cuts and raising the nation's borrowing limit until March 1st. If we go over the second cliff, that could put pressure on an already fragile economy. Along with that, analysts' earnings estimates could be too optimistic for 2013, and the Eurozone is mired in recession. But on the upshot, China's economy appears to be on the mend, the housing market is improving, and there's more tax certainty. With all of these conflicting forces, will the market continue to climb a wall of worry? And where should you invest now? We've got roughly $1.5 billion worth of advice. Collectively, our $1.5 billion roundtable includes Patty Edwards, Principal and Chief Investment Officer for Tru-tina Financial, Todd Schoenberger, Managing Partner and Portfolio Manager for LandColt Capital, and Lee Munson, Founder and Chief Investment Officer of Portfolio LLC. Thanks so much to all of you for joining me. I want to start off with the New Year's tax deal on the fiscal cliff. Todd, how much of a relief is this for the economy?
Okay, well, it's a tremendous relief. First of all, just like you said at the top, Jennifer, you're talking about the uncertainty feature. Clearly, this has evaporated with this, but what we really saw were those holiday sales numbers, the retail sales numbers. They were below Wall Street consensus because a lot of people didn't understand what the tax implications were going to be for the new year, and clearly that did have an impact on demand and consumer shopping. Going forward, though, for 2013, it's a nice short-lived rally that we have right now because we do have some certainty, whether it's artificial or not, but it's probably going to quickly go away once we get into the budget negotiations.
Patty, are economists overblowing the impact of Washington's wrangling on the economy?
You know, I think that the thing with Washington's impact on the economy is that it affects confidence. It's all about the consumer. It's all about consumer confidence. And so to the extent that Washington keeps talking about things and blowing things up like the fiscal cliff, like the debt ceiling, that in turn is going to affect confidence. As you affect confidence, then you affect the markets, you affect how consumers spend, and that just becomes its own virtuous cycle, I think.
I mean, Lee, weigh in here. Do you think businesses were kind of using the fiscal cliff as an excuse? I mean, if you look at the jobs number back in December, it was pretty much on par with what we've seen for 2012. Doesn't it really come back to the fact that perhaps demand isn't at the level that would require investment in CapEx by companies?
Well, you know, I do think that if I were a CEO in a Fortune 500, I would definitely lean on the fiscal cliff as an excuse of why I can't hit my numbers. You know, the truth lies, a little bit underneath that, where every CEO is waking up, they're looking at the recession in Europe, which is real. I think that we could, if we're lucky, we could get out of a recessionary environment or close to it by the end of this year, cross your fingers. So I do think that there was blame put on the fiscal cliff, but I think this is the year we're going to actually see companies start investing in CapEx. But the question is, why are they going to do that? Why? Because they can see an end to the recession, or at least a promise that the European recession will start to come out in the next 12 to 24 months. So CEOs got to start spending their money now. They have to start talking to their board saying, let's get ready for when things happen. Also, we had a wild card that everybody forgets about, which is Japan. Japan is like a lame worker that hasn't shown up to work in like 20 years. And a couple months ago, this dude just walks in and says, I don't know really what to do, but I'll make coffee. I'll try to make myself useful. And so I think that that's going to increase the confidence. That's why I think that we're going to have GDP in this country be closer to 3%, above expectations. I think the market could do better. And I think that just having Japan show up is going to put that little extra push, which is why I'm less pessimistic about the market this year.
Todd, as you alluded to, the tax compromise that is dodges one cliff, but it sets up another one in just 2 months, right? The country's borrowing limit, or debt ceiling, will be breached at the end of February, and on March 1st, those deferred spending cuts of $110 billion, the so-called sequester, kick in. What are your expectations for what a compromise on the spending side might bring?
Absolutely zero, Jennifer. Look, if we went over the fiscal cliff, say we didn't even have the deal in place, you were going to see an almost 20% increase in the year-over-year amount for the tax rolls, yet the spending cuts were going to be decreased by 1/4%. Moving forward, you're going to have the GOP going out there saying, look, we need to have these spending cuts take place if you want that debt limit ceiling raised. But realistically, we all know that they're not going to do that because Obama's in the driver's seat right now. The GOP is the villain. You have John Boehner out there. He could yell and scream all he wants about spending cuts. But realistically, the White House is just going to throw it back out to Congress saying, look, if you don't lift the debt ceiling, then we are all doomed. And therefore, they're going to paint that picture that the GOP are the villains. So going forward, guys, look, I'm not anticipating any spending cuts, but I got to tell you, I don't think Wall Street really cares right now. We're up a lot. We're not up a lot, but up 3% so far in the first couple of weeks of the year. Going forward right now, Main Street, if they go back to spend, if the labor picture can improve, the housing market improves, realistically, Main Street America does not care about that debt ceiling issue.
Right, and Todd, you know, what's interesting now is also that Treasury Secretary Tim Geithner is planning to leave the administration in the middle of all of this, and the president has nominated White House Chief of Staff Jacob Lew. Do you think that that's a good pick or a bad pick?
I don't think it. Look, another guy, though, it's probably even a bad pick because realistically, you have a guy who's going to be an advocate for Obama, especially in those budget negotiations. He's not a guy that's very pro-business. He doesn't. I know he worked at Citi, but realistically, though, he is not going to be the advocate for the business environment. So he's going to really be just a yes man, even though Boehner says all he does is say no. Realistically, though, he's going to really side with Obama going forward.
All right, let's shift gears to the Fed policy because there are a lot of divisions, it seems like, within the Federal Reserve as to whether the current course for purchasing $85 billion worth of mortgage-backed securities and treasuries should continue or end as early as the end of this year. Lee, what's your sense of whether the Fed's unconventional programs could end sooner than thought, and how much wind would that take out of the market sales, if you will?
Well, I mean, let's put it in terms. We've got $85 billion going out right now. With the Fed, you know, there's the thought right now that it's going to be a bit more pragmatic, where we're probably going to go from, say, $85 billion down to $40 billion sometime this summer. But the bottom line, the Fed is very, very clear on one big issue. They are not going to take off QE infinity until unemployment is down at 6.5 or lower. So I think unemployment, just looking at the numbers and drawing a linear line, I think we could be down to 7% this year, but we ain't going to be down to 6.5. So I think until you see unemployment break below 7%, they're going to print. It's a great question if they're going to do $85 billion versus the original 40. I think that's what they're going to siphon off in the summertime, and that's where I think that we could see some big volatility, and we can see the S&P hit an all-time high this year and still sell off before the end of the year, just on the threat that the Fed might tighten too soon.
Great segue into what the market will hold in store for the rest of the year, Lee. So let's talk about that. Todd, last time we had you on the show, you said stay on the sidelines going into the end of last year because of the uncertainty surrounding the fiscal cliff. I know you don't expect a deal on the spending cuts. You said the market doesn't seem to really care about that right now. So what do? Do you buy now? Do you wait after policymakers have kind of dealt with the debt ceiling and spending cuts?
Well, I think Lee would agree with this. This is an excellent trader's market. I mean, first of all, you can look at fundamental and technical analysis all you want, but this is a headline-driven market right now. So for the traders out there, this is great. For the Main Street mom-and-pop investor, though, if you are long stocks right now, take advantage of this run-up, and you can probably expect this for the next month or two. But once we start getting into those headline-driven negative columns out there about regarding the budget, realistically, that's when you want to sell into strength and get out. But then it could be short-lived because realistically, the second half of the year should be quite bullish for stocks.
Patty, if the fiscal cliff is likely to hang over the economy or the market for the first half of the year, will the second half of 2013 be stronger for stocks? And if that's the case, how do you set up your portfolio now?
The first part of 2013 obviously is going to be a bumpy road. I think that we are continuing to go down a bumpy road that is improving slowly but surely. So going into the second half, you're going to see a lot more money come out of the bond markets, and I think you need to be looking toward more of the cyclical stocks, more of the industrial stocks. Those, for the long run, are the stocks that we're seeing the greatest strength and the greatest valuation differentials in, where we think that you can go in there and pick something up that's going to be good for the longer term. An example of that would be something like Ritchie Brothers Auctioneers, which actually auctions off large, heavy equipment. They're going to continue to do well as we start to see pickups and continue to see pickups in construction, for example.
For the weekend of January 7th, investors plowed $18 billion into stocks while pulling $1.1 billion from treasuries. Lee, is this the beginning of the long-awaited reversal of money out of bonds and into stocks?
Oh, I know there's a lot of hedge fund managers that hope that this is going to be, that moment where everybody's going to dump their bonds, the bond markets are going to get crushed, and I guess stocks are supposed to melt up. I don't really think that that's going to happen. All we're really looking at right now is a very, very slow, subtle shift where investors are trying to think, if I have money to commit now, am I going to commit it to equities or stocks, or am I going to commit it to bonds? I think all we're seeing is just a preference more towards equity. There's been so much over the last 5 years that's gone to the bond funds. I don't think any rational trader or investor is going to expect that that's just going to flow out. I think that we've seen the bottom on really long bonds like the 30-year Treasury, AAA corporates, but I don't expect any big moves, especially in the intermediate. So I wouldn't worry about your bond positions this year. But I think that Todd is right. I don't really care about the last half of this year. I only want to see one thing: 1575 on the S&P. If I get it in 2 weeks, I'm going to rebalance. I'm going to sell my equity and I'm going to buy, I'm going to buy some bonds. If I get it in October, great. But we're going to have something bad happen this year. But I'm going to tell you, if you see 1575 on the S&P, you hit the rebalance button, you sell some of your stock, but I don't think it's a cause to change your entire allocation to things.
All right, let's talk about individual stocks and strategies now. The dogs of the Dow strategy did not seem to work last year, even though it did work in 2010 and 2011. The 2013 dogs of the Dow are at&t, Verizon, Intel, Merck, Pfizer, DuPont, Hewlett-Packard, General Electric, McDonald's, and Johnson & Johnson. Patty, would you consider the strategy this year? And if not, are any of the dogs individually appealing to you?
When I look at the dogs of the Dow, I think that's an interesting place at least to start looking, just because of the valuation on some of those names that you mentioned. Some of those names got beaten down, we think, unfairly because of political pressures. The thought that perhaps the dividend tax rate was going to go up to 30 or 40% as opposed to the 15% that we had enjoyed going forward really put a covering over those stocks. Now that that's been lifted, you've seen a decent rebound in some of those, but we still see some good values in there. For example, McDonald's, we see 9% upside, and then on top of that, you've got over a 3% dividend yield on that. Johnson & Johnson, same thing, about a 9% upside just in capital appreciation. You add on the dividend yield, you're looking at 12%. If you could make 12% in a stock anytime in the past couple of years, you've actually done fairly well. And so I think you use that as a shopping list, but you don't necessarily buy the strategy outright.
Let's talk about the two telecom names, at&t and Verizon. Last year was a strong year for both names, and they still offer relatively nice yields. Lee, if you don't own either of these stocks, do you get in now?
Well, I own some at&t in one of our core equity portfolios. It just sits there. It's a sort of an anti-stock. It's there to give a good dividend. But I think that the overall dividend plays are overhyped. I think that if now it's 2013 and you want to, you heard about how, dividend growers are doing well, I think that you've missed the boat. It's an overcrowded trade. Talk to people from S&P, talk to people from MSCI. They'll tell you that those big indexes that cover dividends, the dividend achievers, all that stuff, they're crowded. We like at&t. It's one of the few dividend plays. But in terms of the dogs of the Dow, that whole place, like, where's our Union Carbide? Where's Tylenol? The dogs of the Dow was about things blowing up. None of those companies there are yielding 8%. None of them blew up. And I think that's why the strategy may not work this year. So I think that if you're going to look at a dividend play, remember, it's a crowded market. We own at&t for very specific reasons. But I think if you're just trying to find yield, forget it. Don't find yield. Go find a real company.
All right, let's talk about Apple. The Wall Street Journal is reporting the company has cut its orders for components for the iPhone 5 because of weaker than expected demand. It seems like it's getting tougher for Apple to maintain share in the face of competition, right? You've got Android and Samsung phones that cost less and offer similar functions, particularly abroad. They're not subsidized like they are in the U.S. And to put numbers to that, Apple had, 14.6% of global smartphone shipments in the third quarter of 2020. 2012, down from 23% in the fourth quarter of 2011. Patty, has Apple's iPhone market share peaked? Is Apple the story it once was?
You know, their margins are certainly going to be coming under pressure. For the first time, we actually saw the last 2 quarters worth of their margins come down. That's something that we see on a regular basis out of other technology companies, but not out of Apple. And I think if you look at the Samsung handsets, and if you look not at the original release of the Microsoft Surface, but the new one that's just coming out now, that's the Surface Pro, these things are game changers. Apple hasn't come out with anything that's a game changer in the past year or so. It's just been smaller or different versions of things they already had. Given that, I think that you've got to be a little bit cautious. Absolutely, it's a cheap stock. They've got a lot of cash on the balance sheet. There are a lot of things going for it. Could I buy it and put it away and probably not worry about it? No, because things are changing. So I think you've got to be very cautious when you look at that stock at this point in time.
Yeah, as you said, things are changing, and word on the street as the economy is working on that lower-end iPhone. Lee, do you think one of the reasons why that's the case, why Apple is targeting a less pricey iPhone, is because of the incoming competition? And how worried are you about that and Apple's ability to maintain its high margins if that's the case?
Apple maintains their high margin because they have the superior product and they have a following. And I'm not going to give up my iPhone to buy something from Samsung.
Yeah, but what if you have the lower priced iPhone? They got to make it up on volume, right? If you're going to sell at a lower price.
Hey, listen, I'm not really concerned about who's selling cell phones in Africa right now. I'm really concerned, are they going to make some of those middle markets? Are they going to be able to make an iPhone cheap enough so that people in China can buy it without, thievery or selling their liver? And I think that that's really what we're talking about. Do we have these emerging markets that have already emerged that may not have $400 or $500, $600 to spend on an iPhone, where they might buy some cheaper version? But I don't necessarily think that this is a response to anything. I think it's a premium product. Plus, the thing that everybody has to realize is that one of the stocks that we own is like MasterCard, and it's all about this mobile payment stuff. But I think that technology to take is not going to be on cheap little Nokia flip phones in sub-Saharan Africa. It's going to be when you have a cheaper iPhone or that type of high-level technology, and that's where you start going to have that mobile payment stuff really pick up, and that's going to secure Apple's footprint. And I'm not concerned if there's some little part. They don't make huge margins on their laptops. Nobody's freaking out.
Todd, let's differentiate between Apple the company and Apple the stock. Where do you think Apple's stock goes from here?
It's going way higher. It's going to set a new 52-week high by the end of the year.
What's going to drive that? I mean, you've got so many, relative negative factors here.
Let me tell you something. They have very healthy margins right now. This company with the iPhone 5 will add $48 billion to its bottom line by year end. Think about that. If you take a look at all of the iPhones combined, they amounted to $40 billion to the bottom line. The reason why they haven't come out with any new products is because the infrastructure isn't there. It doesn't do anybody any good if they come out with a new product that's supposed to be the next category killer if AT&T and Verizon don't have the infrastructure set up. That's what they're waiting for, guys. Look, I got insiders over at Apple. They're telling me that's exactly what's going on. They got the iPhone 5 that's rolling out, a special version coming out this summer. It's going to be much more personal, new colors, everything. Of course, there's low demand right now because they're going to have even more demand in the summer. People don't wait outside all night long for a Samsung product. They do it for an Apple product. That's why you want to buy the stock.
All right, there's a showdown on Wall Street over nutrition supplements company Herbalife. And in case you've been living under a rock, hedge fund manager Bill Ackman claims the company is a pyramid scheme and has sold short more than 20 million shares of Herbalife at a cost of more than $1 billion. Last week, the plot thickened when Third Point, a hedge fund run by Daniel Loeb, disclosed that it had bought an 8.2% stake in Herbalife, betting that the shares will rise in value. Todd, which side do you fall on?
Listen, I gotta go. The way I see this, I mean, the products might be great, but realistically, when you heard that analyst call, they never talked about the financials. They never talked about the business model. All I hear about is how everybody's living longer by taking these products. That doesn't do anything for me. I gotta say, there might be something that's a little bit skittish in the background right now, but the stock is rising.
All right, so do you buy in or not?
I wouldn't. I'd stay away from it. Look, anything, all these gimmicks that tell you how to live longer and all this stuff, it's real simple, guys. Don't smoke cigarettes, don't put salt on food, and don't and drink a lot of red wine, and you'll live to be 150. You come and see me if you don't make it that long.
All right, and bank stocks really have had a strong run over the past year. They're starting to report earnings. Everyone seems to be focused on the net interest margins as banks have sort of used up their bag of tricks, right? They've released their loan loss reserves. Unfortunately, they've had a number of layoffs, and we've seen some asset sales. Lee, what do you do with the bank stocks here?
I'm not really interested in bank stocks. I mean, I love to watch them. The only ones I'm really interested in are maybe some of the insurers. I think we own some Allstate in one of our equity portfolios. But the bank stocks, it's kind of like watching the price of oil or price of the U.S. dollar. If they continue to lead in terms of price action, forget about the fundamentals. Nobody really knows what's going on for the last 5 or 10 years in bank stocks. But I want to see that sector continue to trade up. I think the fundamentals are flawed. I think there's too many regulatory concerns. If you got a favorite bank stock, good luck. But I would rather, it's like Herbalife. I'd rather view them. I'm rooting for bank stocks to continue their move up, but I really don't see why an investor, again, unless you're in some little special situation involving insurers or some of the litigation over the past few years, unless you've got some event-driven thing up your sleeve, just watch it. Just put just put bank stocks up there. If they're healthy and continue to go up, that probably means that the market is healthy. Outside of that, find love in something else like red wine.
All right, on that note, Lee, thanks so much to all of you for joining me. It was a great discussion. Hope to see you soon.
Thank you.
Thank you.
Thank you.